Today, the FOMC held rates unchanged.
It's an honor, a true honor, to be back at the Federal Reserve and to take up this duty at a time of such consequence. I've been especially heartened by the warm welcome of old friends and new colleagues both. And I've listened closely to my fellow FOMC members, heard a lot of new ideas, new thinking, and genuine interest in moving the Fed forward. This week's FOMC meeting exemplified the very best of the Fed's traditions: rigorous debate, open-mindedness, commitment to mission, responsibility, and accountability for performance. In this business, they all add up to one thing: getting monetary policy right, or as near to it as we can do. That is our North Star. My colleagues and I are here to serve our legislative remit, which you've heard us say before: price stability and maximum employment. And these objectives guided our business in the meeting just concluded. As you saw a few moments ago, the committee decided to maintain the target range for the Fed funds rate at 3.5% to 3.75%.
Importantly, this is Kevin Warsh's first day as Fed Chair. We'll be going over what happened today at the FOMC, why certain things were said, what could be next. Kevin Warsh didn't provide forward guidance, and in fact, one of the changes he's making at the Federal Reserve is to eliminate forward guidance from the statement altogether. Sri-Kumar is here today. Komal Sri-Kumar, president of Sri-Kumar Global Strategies, is with us to break down what happened today and give us his outlook for what the FOMC may do throughout the year. I couldn't think of anyone better than yourself, Sri, to come on the show. Thank you very much for joining us.
David, thank you so much for inviting me. It's a pleasure to be with you on Fed Day.
Let's go over some of the biggest changes. Warsh wants to set up new task forces: communications, balance sheet policy, data collection, productivity and jobs, and inflation framework. Now, he also said that there will not be any forward guidance in statements. That was a big part of the press conference when reporters asked him, well, how are you going to communicate forward guidance if you're not going to use forward guidance language in the statements? Will we just use the dot plots instead, was one of the questions. I think those were my key takeaways from watching the press conference and the key changes. Your response to what you saw, and we'll get into the specific details on inflation and employment in the economy.
Some of the points, the points that you made are, I think, very much there. They were the key issues. Dot plot is being de-emphasized, is what the new chairman said. But think about the results that they had to convey. That 9 of the 19 members who were together in that room thought that interest rates should be increased by before the end of the year, and some of them by more than once before the end of the year. So clearly, the only person who didn't vote on that was Kevin Warsh himself. Everybody else was voting, and many of them thought that the interest rates would go up. That is, I think, a crucial point that comes out of the whole discussion. The others are that as he's trying to corral support from the other people, clearly, I think he's going to lose control over this Fed, because if he's not going to give forward guidance, David, if he's not going to speak regularly, he cannot stop the other members of the Federal Open Markets Committee from talking. So they are going to talk to the press, and they are going to say different things in public. And keep in mind, he's not their boss. He's not their supervisor. He's just the chairman of the board. And the other members have their own freedom to be able to speak to the press as and when they like. And so I think there is going to be more confusion ahead. So I don't know if we should talk about the interest rate movement since he started to speak, or should we do that later?
Yeah, let's do it now, since you brought it up. Very good point. Market reaction, the S&P is down 1.2%. The NASDAQ is down as well. Gold is down 2.3%. The two-year yield rockets higher. Bitcoin is down 2%. Why did a short end of the curve move the way it did, Sri-Kumar?
The short end of the curve moves up, especially the 2-year, which moved up 15 basis points or so by the end of the day. That happened because the expectation is that there are going to be more interest rates coming before the end of the year. Think about what President Trump was asked in France at the G7 after the G7 meeting. And he said, well, they can do whatever. We have a great person there, but he was upset that they are talking about a rate increase, but he seems to be resigned to that happening. So the markets are taking all of that into account and realizing that interest rate increases are going to come. That's why the short end moved up so much. The question for your listeners, David, is what happens to the 10-year and the 30-year? 10 and 30 did not move very much today. But if you have more confusion on the 2-year side, and if inflation is not controlled before the end of the year, expect the 10-year and 30-year to move up as well. So clearly, this is a chairman who has to change the way he operates between now and the end of the year.
What did he say that prompted markets to believe there will be more interest rate hikes?
The fact that there were 9 members of the FOMC who thought that rates should be increased by the end of the year. That's one reason. Second, Warsh said that the FOMC clearly is emphasizing inflation control and is taking the 2% target seriously, because some people thought he might come forth and say, well, we can be flexible, we can go to 2.5%, 3%. What's a big deal? He didn't do that. He said 2% is still relevant. And that, I think, was the second reason why the markets took fright and the yields moved up.
Before we continue with the video, let me tell you about a very important topic, which is your personal information. Now, your personal privacy is of utmost importance, probably even more so than your personal assets. And your personal information is likely online right now. Your full name, home address, and phone numbers are sitting on data broker websites that anybody can access or buy. I bet you probably didn't know that. So that's exactly why I use Delete Me. Our sponsor today, Delete Me, removes your private information from hundreds of data broker sites, and since June 2024, it's removed 204 of my listings, and my latest report shows 335 listings were reviewed last month. That's what I like. It's consistently and constantly checking so nothing slips through. Getting started is straightforward and easy. Just submit your information, and in about a week or so, you'll get a report showing where your data was found and what was removed. And it doesn't stop there. Delete Me keeps scanning the internet and removes your data throughout the year. So go to joindeleteme.com/DavidLin, link in the description down below, or scan the QR code here and use my promo code DavidLin at checkout. New users who use my code will get 20% off of all US plans. Take your privacy seriously before somebody else does. Let's take a look at Kevin Warsh's history in order to gauge what he may or may not do next. Kevin Warsh, for those of us watching the show who may not be familiar with his history, was previously on the board of governors between 2006 to 2011. His philosophy was that inflation risk should not be ignored. Monetary policy is a powerful tool during crisis, and he was at the Fed during 2008. And he was still fighting inflation under Greenspan before Bernanke had taken the chair in 2006. After the financial crisis of 2008 and 2009, Kevin Warsh was pretty vocal about speaking out against QE. He left in 2011. He wasn't officially protesting, but a lot of people suspected at the time that perhaps his departure was a sign of a silent protest against the rapid balance sheet expansion that followed after 2008. Right now, I bring this up because right now, the balance sheet of the Federal Reserve has been climbing. If you take a look at the screen here, Sri, you can see that from a percentage change basis, the balance sheet has been climbing in positive territory for a few months already. Now, the importance here is that Kevin Warsh has said in the past that he is a monetarist, or at least he believes in monetarism, which is a 180 shift away from Jerome Powell, who has said we need to unlearn monetarism. My question is, given his track record, given his stance on monetarism, and also given the balance sheet of the Federal Reserve having increased in recent months, do you think Kevin Warsh and the Fed will start tapering soon and tightening QT, tightening the balance sheet? And if so, what would the impact be on the bond market? Let's start there.
My expectation is that the tapering of the balance sheet, what is known as quantitative tightening, is unlikely to resume anytime soon. As you said, David, just a few months ago, they started increasing the balance sheet again. And I think the reason was concern that they may end up with one more cash crunch like we had in September 2019, or the regional banking crisis, which we had in March of 2023. The Fed did not want to face that again in the opening months of a new chairman, and so they decided to postpone it. And think about what happened today at the FOMC meeting, as well as in the Kevin Warsh discussion. There was no mention about balance sheet tightening anytime soon.
That's right.
They talked about interest rates, but they did not talk about the balance sheet. I think that was for a specific reason. They do not want the market to get very agitated about the balance sheet and to have a cash crisis yet again. We have had a big expansion in speculative investments over the last several months. And the last thing the Fed wants to do is to cause a financial crisis, an accident, by talking about it. So I don't think it is going to happen anytime soon. And so there is going to be a difference between what Warsh said before he became chairman and what he is going to do when he has become chairman. One other thing, you talked about when he was the governor of the Federal Reserve during 2006 to 2011. During that time, he was known as an inflationary hawk, a monetary hawk, who even in 2009, when unemployment rate was very high after the financial crisis, he thought the Fed should not be expanding the balance sheet. And that situation completely reversed in a Wall Street Journal op-ed article he wrote late in 2025 when he was considered a candidate for chairman. He said interest rates should be cut. What changed? Once he was not a candidate for chairmanship, and the second time he is. So campaigning can make strange bedfellows, and you had him suddenly changing his view before it. So what he may do yet as a chairman, you have to be very careful because they may be very different what he said in late 2025.
Let's come back to the balance sheet in just a minute. I want to talk about market reaction. This is from the SCME Fed Watch tool. Like you said, the 2-year yield, short end of the curve rose dramatically on the expectation that there may be interest rate hikes. Immediately after the FOMC press conference ended, we saw a dramatic rise in the probability of a 25 basis point hike by the next meeting, which is July 29th. Let's go forward here. September, there is now basically a greater than 50% chance there's going to be at least one 25 basis point hike, perhaps even a 50 basis point hike. By October, that probability has now shifted overwhelmingly in favor of at least one hike, only 25% chance it will stay. And by December, that probability has dropped to only 13% that the Fed funds rate will stay, and overwhelmingly in favor that there will be at least one, perhaps even three 25 basis point hikes by then. No chance of a cut at all. Do you agree with market expectations? Or is this a little bit too aggressive?
I agree with market expectations. I have been saying on your show, David, as well as in my writings, even before the Iran war, that the Fed should be increasing the interest rate to keep inflation under control. Now that the Iran war has been on for more than 100 days, and despite all the talk about ceasefire, we have had so many discussions that has not happened. So I'm not sure that oil price coming down in the last few days is sustainable. And if there is an attack on Iranian territory again by US forces, I would expect that as a result of that, oil price would go up yet again. So those are the uncertainties. And even if oil price doesn't go up, it is going to take a while for inflation to come under control. All of those say to me, in answer to your question, that interest rate increases, perhaps more than one, is more likely than interest rate being kept the same or even cut as the president would want it to happen.
If somebody were to ask you, Sri, why is the Fed changing its stance now? How would you respond to that? Take a look at the Fed funds rate. The Fed has been in a period of easing ever since late August 2024, starting from 5.3% all the way down to its current level of between 350 basis points and 3.75%. And what has changed between the last 2 years and now, fundamentally in the economy?
In the last, toward the end of 2024, keep in mind, November was the presidential election period.
Yes.
And I have maintained that Jerome Powell, as chairman of the Federal Reserve, would rather have Kamala Harris be elected as president rather than Donald Trump come back, because their relationship had already been poor at the end of the first term. So there was no reason, and again, I said that in my writings repeatedly, that the cuts in interest rates that were done toward the end of 2024 were not justified, they were not required, because Powell said at that time, our employment is the major threat, inflation has been completely controlled. It turned out to be just the opposite. So the Fed, the outgoing Fed, has not been quite honest in terms of telling us what it is that was happening. And the reaction, the cut in the interest rates that happened, put more money into consumers' pockets, and I think gave rise to further pressure on inflation during 2025 and 2026.
Well, even let's say you're right, and there was no economic justification for lowering interest rates besides political motives. President Trump, ever since taking office, has repeatedly wanted interest rates lower from even today's level, which is arguably why he appointed a loyalist in the form of Kevin Warsh. However, now things have changed. Why did Donald Trump want lower interest rates? Was there any economic or business justification at all for lowering interest rates beyond what they were already at?
To see that, go back and look at Donald Trump's personal history. He comes from real estate. He was a real estate investor in New York City, New Jersey, and Queens, New York. Real estate people typically want interest rates to be lower because that is, again, the bane of their profession. That, again, helps the construction industry. It helps real estate. So keep in mind that the president has wanted interest rates to be lower no matter what the inflation rate was. This, to me, reminds me of the situation with President Richard Nixon in the 1970s, when he wanted Fed Chairman Arthur Burns to cut interest rates even though inflation was going up. So they both came from a perspective that lower interest rates is always a good thing. But if you're really a monetarist, you know that is not the case. And that's not the ultimate solution to the problems that we have.
Let's address inflation directly now. I like this question by Brian Chung, reporter at the FOMC press conference. Take a listen.
Hi there, Chairman Warsh. Brian Chung with NBC News. Thank you for taking our questions. So when you say that we've dropped forward guidance for the layperson, that might sound like the Fed's going to say less or offer less insight into where their borrowing costs might go. So for the person that maybe you might run into at the grocery store, where the price tags are rising at a faster pace than their wages at the moment, how would you explain it to them? I don't know if task force might be the answer there, but how would you kind of communicate this era, this chapter of the Fed?
If I told somebody in the milk aisle that I had a task force for that, I think that would be doing a very poor job. So I appreciate it. If I saw somebody in the grocery store, what I would say to them is that we cannot have a very significant effect on particular prices. The price of oil in the markets today, or even the price of a dozen eggs, that does not have first order consequences to what we're doing. But we do have a really important job there. And it's to make sure that those changes in oil or beef or eggs or milk don't broaden in the economy, don't have second and third order effects. That's our job. That's our commitment. That's our capability, and we're going to deliver on it.
How would you answer that question if the reporter asked you? How would you communicate to somebody at the grocery store why his eggs and bread are now more expensive?
I would basically say that even though it is true what the chairman said, that it is this widespreading effect of egg price or beef price that is important, The individual item is what shows up for the consumer. It is what is politically important. And they all think that derives from monetary policy. They agree. But what is the chairman going to do about it is to try and keep that inflation rate down. But look, David, at what he is planning to do. He has suggested a new concept called trimmed mean inflation, which means in reality, if egg prices and beef prices shoot up a lot at the extreme, the Fed, by this measure, would not calculate it. They would drop them out. They would look at only the ones which did not move very much at the upside or the low side. So you will end up today with a figure like 2.3 or 2.5% inflation, not the 4.2% inflation. So what I think the chairman is doing is to say, I'm not going to worry about beef or egg price by itself. I'm looking at the overall index. But he's also indicating that that he likes the current index. And think about it, the task force that you talked about at the beginning, the third task force and the fifth task force, both have a responsibility of looking at the price level and what price index is going to be used. And so my fear is that if he decides that the consumer price index is not a good measure because it is showing the Fed failing, he ends up then getting his trimmed mean indicator, and that will show a much better inflation figure preferable to himself. So you will not get the reality out of what he is saying, and I think there is no escape from it. You simply will have to increase interest rates and manage the monetary policy in a much tighter fashion.
Do you think that the rising prices at the grocery store, just to make an example, but inflation overall was a consequence of higher oil prices because of the Iran war?
It is starting to be a higher an implication. How is that happening? Higher oil prices translate itself into higher price of fertilizer, higher price of gasoline, which you need for the trucks to bring the vegetables, the eggs to the store you buy from. And that is the way in which the transmission takes place. So yes, the Iran oil situation is very much a factor in why we are paying more for beef or eggs, but it's not the only reason, but it is a major factor.
My question then is, the Strait of Hormuz is now unofficially or officially open. We'll see if it closes again. But a memorandum has been reached over the last weekend. The oil price has fallen $75 to $75 a barrel from $90 just a couple of days ago. Personally, I witnessed huge lines at the gas station where I live in Vancouver just last night. I haven't seen anything like that in months. People were lining up out the door because gas prices fell considerably overnight. Now, let's assume that the Strait of Hormuz remains open and a deal with Iran is reached, and there's no further escalation to the Iran war. Then my question is, why do interest rates need to go up? The oil crisis has taken care of itself. Oil has come back down. We don't need to raise interest rates to contain inflation. The inflation problem will disappear by itself. Your response?
Two reasons. One, even though the oil price, the price of a barrel of crude oil has come down significantly, it is going to take a few months before it translates into lower price of gasoline at your Vancouver gasoline station, for example. There is a time lag. And so that is one reason why the inflation is going to stay high. Second, it has already been passed on to fertilizers, and the farmers have paid more for the fertilizer as a result of the past higher price of oil. So they are not going to reduce the price of eggs. So again, to go back to that example, just because Iran has reduced the oil price as a result of the Strait of Hormuz being open. So what I'm saying is that the impact of lower oil prices takes a while to get registered in the price indexes.
So then, given your outlook on inflation and on the economy, do you believe that the economy can withstand higher interest rates, 1, 2, or even 3 25 basis point hikes by the end of the year?
It probably will not. If you're assuming 3 rate hikes between now and December, you would probably see the signs of stagflation showing up during calendar year 2027, meaning that inflation still remains high, but the higher interest rates start to curb investment spending, consumption spending. So at the same time, you also have a slowdown of economic growth. So the answer to your question is there is no escape from it. If you have maintained a very easy monetary policy for a long period of time, you have to pay the price for it. There is no free lunch. And the price that you're going to pay is both higher prices, higher interest rates, and slower economic growth.
What is the lesser evil here? Curbing inflation or letting the economy run such that we don't hurt the labor market more by raising interest rates?
I think the more important thing is to curb inflation, because if you do not curb inflation, you are not going to be able to control the other factors in the economy. One of the good points, by the way, in relation to your question that came out today from the press conference, recall there was no reference to unemployment rate. Usually, Jerome Powell would say, well, we have two mandates. We have to worry about inflation. We worry about employment. And we shift from one to the other depending upon which one is more important. That did not happen in today's press conference. Inflation, inflation, inflation. That was the only target that the chairman was focused on.
This is a tweet from Judy Shelton, also a prior guest on my show. Kevin Warsh effectively just stated he doesn't believe in the Phillips curve trade-off between inflation and unemployment. She liked it, I guess. Bravo. Okay. The Phillips curve, very broadly speaking, inverse relationship between unemployment and inflation, which is to say, if one variable goes up, the other should go down. If you have a hotter inflation rate, that should indicate lower unemployment, and vice versa. Now she's suggesting that Kevin Warsh doesn't believe in this relationship and that the two can run together. You could have higher inflation and also higher unemployment. Your take on not just Kevin Warsh's attitude, but your take on the Phillips curve overall. Does this relationship actually hold outside of a textbook?
Yeah, I do not believe in the Phillips curve either, meaning that you're not going to have a trade-off between unemployment and inflation. And which is why I said, if there are going to be 3 rate increases between now and year end, you're going to have both higher inflation and higher unemployment rate. So in other words, I don't believe in the Phillips curve concept either. And I think there I feel the same way as Judy does, and the same way as Kevin Warsh believes as well.
What do you think the yield curve is going to do? If we have rate hikes from the Federal Reserve, the 2-year yield, the short end of the curve should move up. What about the long end of the curve?
I think you're going to have a flattening of the yield curve. It's already flattened quite significantly today because the 2-year moved up 15 basis points in yield, and the 10-year, depending on what is the last figure you're looking at, probably moved up about 2 basis points. So clearly you had a flattening of it. But if you continue to increase interest rates at the short end, the 2-year is going to keep increasing and the 10-year again may flatten. But if the inflation fears increase, David, the whole curve shifts up even though it is flatter. You're with me? So in other words, it becomes a flatter curve, but not at the same level. All the interest rates turn out to be higher, and that is the risk for Kevin Warsh and for this economy.
What then happens to markets when we have a flattening yield curve?
When you have a flattening yield curve, the question then becomes, with the flattening yield curve with a higher level does not provide relief to anybody, because for those of you who are borrowing short term, you're going to be paying a higher interest rate. And you may think, hey, if I borrow for a mortgage for 10 years or 30 years, do I pay less? No, you're not paying less. The spread between what you pay for the 10-year and what you would have paid for 2 years has gone down, but both rates have gone up. So I think there, I would say what is important is not the slope of the yield curve, but the level of the yield curve, how much it has moved up by.
Well, all this rests on the assumption that the Fed will raise rates. A question was asked directly, under what conditions will the Fed raise rates this year? Take a listen.
Thank you so much. Colby Swift with the New York Times. You've in the past said that inflation is a choice, and in the policy statement, it includes this pledge to deliver price stability, as you've reiterated today. But looking at the SEP, the bulk of your colleagues expect core PCE to run around 3.3% by year end, and for the 2% inflation target not to be reached until 2028. So I'm curious how patient you think the Fed can afford to be at this juncture in terms of waiting for one-time inflation waves to wash through and for underlying inflation to step down after so many years of inflation running above target, and under what circumstances you would support the Fed taking some action and raising rates.
Sure. So quite a bit there. Let me try to break that into pieces. First, we have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do. In the Fed's review of its strategy over the last any number of years, in January, the Fed, including the strategy that we're still bound by, the Fed statement says that inflation is primarily determined by monetary policy. You bet it is. I've said for years inflation is a choice. You bet it is. And today I'm announcing that this committee unambiguously and unanimously have decided we are going to deliver on that. The rest of your questions sounded like an encouragement for me to give forward guidance. We've dropped forward guidance. Some along the committee, I think, dropped it.
Yes, we've discussed dropping forward guidance. Okay, inflation is a choice. I think I know what he means, but I'll let you answer that. What do you think he means?
What he means by that is that we can either have 2% as a target, or I, Kevin Warsh, could have told you today that we will be willing to accept 3 or 3.5%. That is what he means by saying inflation is a choice. However, he was very clear in suggesting that the 2 number still remains valid. And the reason he said that, and the reason that is important, if he said that inflation is a choice and we are going to choose 3 or 3.5%, then the yields would have shot up at both the 2-year and the 10-year yield today if he had made that statement. So he had to be very careful in terms of stating it. And he had to indicate that while he doesn't want to give forward guidance, he's still telling you that 2% continues to be his target.
Back in 2018, I attended a CFA event in Montreal, Canada. The former Fed chair was in attendance, Janet Yellen, and she was making a speech. And somebody asked her what causes financial recessions or just contractions in the economy overall. And she said 2 things cause recessions. 1, financial imbalances, and number 2, the Fed. And there was laughter from the audience. People, found that funny. I think she was half joking, but let's take that, seriously here. If monetary policy has a direct impact on economic growth, what do you think will happen this year?
This year, I think because of the fear of inflation, the second half of the year, I think we will see the growth rate coming down under pressure. Because despite the fact that today we had some very good retail sales numbers, employment has continued to be very strong. But typically, when you have a shock, that registers itself suddenly. It does not happen gradually. And the same thing was true of the 2008 situation. October 2007, we thought we were actually in a peak. And the S&P 500 reached a record high, but the recession began 3 months later in December of 2007. So what I would say is that is going to put pressure on the economy and economic growth. And I think that was the point I would be very concerned about.
On how the Fed responds to data, the prior Fed Chair Jerome Powell was very clear in pretty much every single conference that the Fed is data dependent. Now, we know what that means. They look at official data, usually lagging because it came out a month ago. Now, Kevin Warsh said that he wants to focus on trends rather than individual data points. What are the pros and cons of this change? Do you think that maybe looking at trends would provide a bigger, more complete picture, or does it just give the Fed an excuse to ignore certain data points they don't like?
I think it is the second. It's the latter. I think it is going to give the Fed an excuse to behave differently from what the market would anticipate. And I think for that reason, there is a price to pay. Namely, there is going to be more volatility because nobody knows what the Fed is going to do because they haven't given you a clear guideline. So the absence of forward guidance, in my opinion, is that there is going to be more uncertainty, more volatility in markets, which you would not have had if the Fed had given you proper guidance in the past.
Besides what we've discussed so far, what other core differences arise between Kevin Warsh and Jerome Powell?
We referred to many of them, so let me make sure I think about them again. One, that there was no, the size of the write-up, the conclusion used to be much longer in the FOMC decisions in the past. This was just a short two-paragraph write-up. That is clearly by design. Second, there is no very detailed dot plot. They don't tell you which members asked for a bigger increase, which did not. And they just said 9 people asked for an increase. So that's a second difference. Third, the chairman himself did not express his opinion about interest rate. And that is, I think, the third major difference. And I would say that that is key, because if he's going to behave the same way meeting after meeting, he just becomes an observer. He watches what everybody else says about interest rate as if he doesn't have a view of his own. And that doesn't cut it with the markets. And that, I think, is also going to be a reason why interest rates would face upward pressure.
Are there core differences in their economic philosophy or school of thought? Jerome Powell coming from a legal background and Kevin Warsh coming from a business family. And he also stated, Kevin, and I mentioned this before, he stated that he believes in monetarism, which is to say that perhaps he will pay closer attention to the money supply. What does that mean, practically speaking, from a Fed policy perspective?
I personally prefer the Kevin Warsh approach there. Why? Because clearly I believe as well that inflation is a monetary phenomenon. And if he sticks to what he said, and monetary policy is going to be oriented only toward inflation, not toward employment, that would be a big difference from Jerome Powell. The problem with the Powell approach is when you have both inflation and employment as your objectives, you keep switching from one to the other. And I call it the decision making by the seat of your pants. There is no firm policy in terms of how you're going to move. And that created a lot of uncertainty in the Powell Fed, which I think is an improvement now with Kevin Warsh saying clearly it's a monetary phenomenon and the focus of monetary policy is going to be on inflation.
Finally, in this current environment, looking forward, we have higher interest rates from the Federal Reserve, a flattening yield curve, and potential economic slowdown because of these conditions. Which assets might outperform or survive in this particular condition?
Clearly, on the fixed income side, you want to lower your duration of your holdings, shorter terms holding rather than longer term. And if the long-term yield increases significantly during the months to come, there will come a time when you should switch over from short to long-term holdings. But right now, I think this is going to be where you want to be. Second, on the equity side, energy still, I think, have a way to run despite the recent drop in the oil prices. I would also mention with the big upward run in tech, and the concerns about technology, shift some of your asset allocation to value-oriented sectors which have not moved up as much. So those would be 2 or 3 of the recommendations that I would make.
Real estate is already hurt both in the U.S. and Canada, slowdowns in both rental markets and the first new home and existing home markets. What happens when interest rates go up even more?
When interest rates go up even more, clearly real estate will be probably less hurt than some of the other areas because real estate, as you said, has already taken a hit. And real estate is also more stable over the longer period of time. And if you are going in when the cap rate has increased, namely the yield has increased in real estate, that will give you some amount of protection from the situation of higher interest rates.
Before we go, tell us a little bit about your Substack. You have a very good collection of writing on your Substack, which I'll put the link in the description down below. People can check that out. What are you working on now, and what will be your, give us a teaser of some of the pieces you have in mind, especially following today's first appearance by Kevin Warsh.
I think this coming Saturday, I'm going to be talking about how successful Kevin Warsh was in conveying his ideas to the investing public. That would be important. And what does it mean for interest rates to have shot up so much? What is the indication coming from that? And also whether the investors can depend on the ceasefire with Iran to imagine that inflation is going to come down, and that is going to be much less of a factor in coming months. So that also would be one of the areas I'd be looking at.
Okay, very good. We look forward to those topics, very timely topics, questions I would ask myself to my guests on my show. So do subscribe if you haven't already to Sri-Kumar's Substack, link down below. Thank you very much. Anywhere else we can find your work or follow you, Sri, before we go?
Yeah, surely. I have my website, Sri-Kumar, www.srikumarglobal.com. I also put my views on X at Srik, S-R-I-K, Global. And then my company website, if you go to the website, there again I post it, including David, the result of our discussion will be on hopefully by tonight or tomorrow.
Yes, we can expect that definitely out soon. Thank you very much, Sri. It's always good to have you, and you have wonderful insights on the Fed and the economy. And well, we're very thankful for your time. Thank you very much.
Always a pleasure to talk to you, and it's always a great discussion. Thank you, David.
Thank you very much, and we'll put the links down below. Make sure to follow Sri-Kumar there. Thank you for watching. Don't forget to like and subscribe.